Welcome to this explainer. If you've been anywhere near the internet lately, you have absolutely seen the AI headlines. In fact, you've probably seen so many of them that the massive numbers have just completely stopped meaning anything to you, right? Every single week, it's another $100 billion, another massive mega campus being built, another record broken. The numbers have gotten so absurdly big that we've kind of become entirely numb to them. They're just something you scroll past on your feed, think, oh wow, for a split second, and then you're right back to watching a guy make pasta. But we really shouldn't be moving on so fast. We need to stop scrolling and actually look at the scale of what is happening right now. Because the reality, it is literally mind-numbing.
$700 billion. That is what big tech is on track to spend building out AI this year alone. Just to put that colossal number into perspective, that represents roughly 2.5 cents of every single dollar the entire United States economy produces. It's a staggering amount of capital being mobilized faster than almost anything we've seen in modern economic history.
And hey, it's not just me saying this. The CEO of NVIDIA, Jensen Huang, is calling this AI push the largest infrastructure build-out in human history. Let that sink in for a second. Larger than the entire interstate highway system, larger than the early telecom networks. But amidst all these massive announcements and grand visions for the future, there's a glaring question sitting right in front of our eyes. A question that almost nobody is asking.
Okay, let's dive into this. Because transitioning from this highly visible spending spree into the central financial mystery of our explainer reveals something truly astonishing. How does an industry, even one as wealthy as big tech, finance the largest infrastructure build-out in human history? Well, the answer to that starts with one number, and it's a number that is hiding completely out of sight.
The discrepancy here is sheerly staggering. One recent study actually found that just 5 top tech companies owe $1.65 trillion in obligations that never actually appear on their balance sheets. Meanwhile, those exact same 5 companies report about $1.35 trillion of visible debt on their books. So the hidden pile of debt isn't just bigger than the visible one, it is significantly bigger. Take Meta as an example. Their off-balance sheet debt is nearly triple their reported debt. And look, moving that much money out of sight isn't a magic trick you can just invent overnight. It takes a highly sophisticated system.
Section 1. Shadow Banking. Growing in the Dark.
To really understand this system, we have to take a quick trip back to the summer of 2007. We're at the Federal Reserve's symposium in Jackson Hole, right before the global financial crisis tore through the economy. There, an economist from PIMCO named Paul McCulley gave a dire warning about a second banking system that was growing rapidly in the dark. He called it the shadow banking system. Basically, it's an unregulated network of institutions that borrow and lend like banks, but crucially, they aren't banks. That means they operate with no deposit insurance, no Federal Reserve safety nets, and absolutely none of the regulations written to keep traditional banks from collapsing. And here is the truly wild part. This exact same financing family, the machinery that broke the global economy in 2008 when it was built on piles of mortgages, is now being actively used to fund AI data centers.
So the crucial point here is understanding how this machinery actually functions. Let's deliberately slow down for a second and break down the mechanics of what McCulley called the alphabet soup of vehicles. Let's use an analogy. Imagine a company called the Acme Corporation. Acme wants to borrow an amount of money, but they do not want that debt showing up on their own books and scaring their investors. Step 1. Acme creates a second, technically independent company called a Special Purpose Vehicle, or SPV. On paper, Acme and this SPV are completely separate entities with their own bank accounts. Step 2. The SPV goes out and takes on a massive amount of debt. Step 3. The SPV uses that borrowed money to buy the exact assets that Acme needs. And finally, Step 4. The SPV simply leases those assets back to Acme for them to use.
And this brilliantly illustrates the ultimate financial loophole. In plain English, the tech company gets to use the multi-million-dollar asset while legally claiming zero debt on their own balance sheet, all because the SPV technically borrowed the money. It's exactly like opening a credit card in your cousin's name. You're the one swiping the card, you're the one enjoying everything it buys, but when the bank knocks on your door and asks about your debts, your answer is, technically, zero.
Section 2. Draining the vaults. Running out of cash. Now, historically, tech giants have been viewed as the safest borrowers on earth, carrying the lowest net debt-to-earnings ratios of any sector in the United States. Initially, their plan was simple. Just let their massive cash machines pay for the AI build-out. But the sheer scale of this thing changed the math entirely. For most of the last decade, these companies spent roughly 40 to 50 cents of every dollar of cash their businesses produced on reinvestment. But listen to this. This year,
PIMCO estimates that has skyrocketed to 94 cents. The vault is no longer simply funding the build-out. The build-out is rapidly draining the vault.
So when the cash ran low, they hit the debt markets at an absolute frenzy. From 2020 to 2024, the top 5 hyperscalers issued an average of $28 billion a year in bonds. By 2025, that jumped over $100 billion. And then, just look at the explosion in 2026. In just the first 5 months of 2026, they issued another $159 billion. Let me repeat that because it's insane. They borrowed more in just 5 months than they did in the entire previous 5 years combined.
It's gotten so extreme that the tech sector now accounts for nearly 18% of total U.S. investment-grade debt, officially alarming people like Tobias Adrian at the International Monetary Fund. The U.S. dollar market simply couldn't absorb all this debt anymore, so they had to go international. Take Alphabet's extreme measures, for example. In February, they raised $32 billion in under 24 hours. They had to issue bonds across 4 different currencies. They even threw in a 100-year bond, which was somehow 10 times oversubscribed. Overnight, they became top bond issuers in currencies where they literally had zero presence a year prior. But even these global markets have limits, right? You can only put so much debt on your official books before investors start to panic.
Section 3. The Beignet Blueprint. Hiding in plain sight.
So when everywhere else runs out of money, the shadow banking machinery turns on, hiding deep within the crowded footnotes of public financial filings. If you know exactly where to look, you find the blueprint that every single major AI infrastructure deal is now copying. It started with the deal that became the largest project financing ever completed as an investment-grade bond. $27 billion, all set up to build a massive, multi-gigawatt data center campus in rural Louisiana called Hyperion. But you won't find it on Big Tech's main balance sheet. The whole shebang rides on a special-purpose vehicle named after a New Orleans fried pastry, Beignet Investor.
Here is exactly how this pastry-named shadow machine works. A private investment firm called Blue Owl Capital creates the SPV, Beignet Investor, and puts up 80% of the equity. Meta takes the remaining 20% slice of the equity. But make absolutely no mistake, this is a Meta project through and through. Meta announced it, Meta designs it, Meta builds it, Meta operates it, and Meta is the sole tenant it will ever have.
But here is the climax of this entire financial structure. When it comes time to borrow the money to actually build the massive Hyperion data center, the pastry goes borrowing. Beignet issues $27.3 billion in debt. All of that staggering liability belongs entirely to the SPV. It sits completely off Meta's official balance sheet, allowing them to expand at breakneck speed without spooking their traditional shareholders with mountains of new debt.
So we are currently witnessing the largest infrastructure build-out in human history, fueled by a hidden system of astronomical debt, using the exact same financial blueprints that famously collapsed back in 2008. The scale of AI's ambition is matched only by the scale of the hidden leverage funding it, which leaves us with one final, very provocative question to consider. As this hidden infrastructure build-out continues to scale into the trillions, if the shadow banking machinery breaks again, who is left holding the cousin's credit card? Thanks for joining me on this explainer. I hope it gave you a whole new lens to view those AI headlines through. If you've been following the AI boom, we're uncovering the hidden mechanics behind how the largest infrastructure build-out in human history is actually being funded. Because, we all see the massive headlines, right? The endless construction of new data centers, the unimaginable piles of money pouring into tech. But here's the thing. The real story, it's not happening on the public balance sheets. It's playing out in the footnotes. Let's get right into it.
Okay, let's start with a really massive anomaly. I want you to think about this for a second. Meta builds a giant, hyper-customized data center. They pack it with their own proprietary servers, their engineers run the whole operation, and they have total control. But legally speaking, they do not hold the multi-billion-dollar debt for it. So how do you legally hide billions of dollars in data center debt while still having complete control of the facility? How on earth did they pull that off?
Well, that brings us to part 1, the off-book magic trick.
Let's break down this mechanism by looking at a specific financing vehicle known as Project Beignet. This was set up to finance Meta's massive Hyperion data center down in rural Louisiana. Now, on the surface, it just looks like a standard real estate transaction. But under the hood, it is a fascinating piece of financial engineering, designed specifically to keep debt totally invisible to the public markets. So here's how the whole shebang actually works. Major bondholders, we're talking some of the biggest money managers on the planet,
like BlackRock and PIMCO, they wire the cash into this vehicle, BNet, to actually build the facility. And then comes the final step. Meta simply moves in and pays rent. It's literally that rental income that slowly pays the bondholders back, year after year, all the way out to 2049. But here is where it gets really interesting. The ownership split. An investment firm called Blue Owl owns 80% of this venture, while Meta legally owns just 20%. Now, why does that matter? Well, because of one highly specific phrase in the accounting rules. By holding exactly 20%, Meta is technically not considered the primary beneficiary of the venture. And since they aren't the primary beneficiary, poof, that $27 billion in debt completely vanishes from their balance sheet. Legally, it's just not their debt.
Which leads us perfectly into part 2, reading the fine print.
To really grasp what's going on here, we have to look past that public-facing story of, oh, we just rent the building, and dig into the private realities buried deep in the financial filings. Because what a company tells Wall Street on a Tuesday earnings call versus what they legally promise their bondholders in a massive contract can be two very different realities. And this brilliantly illustrates the catch. Tucked way away on page 106 of Meta's annual report is this dense little sentence about residual value guarantees. What does that actually mean in plain English? It means Meta legally guarantees the building's floor value up to $28 billion. So if Meta ever decides to walk away and the facility drops in value, Meta has to write a massive check to make those bondholders whole. It's honestly a masterful double narrative. They get to tell Wall Street the debt isn't theirs, while simultaneously promising the bondholders their money is totally safe.
But take a look at the risk this creates. It's a terrifying timeline mismatch. The bondholders are holding a 24-year loan on this facility, but Meta's lease? It doesn't even kick in until 2029, and it only renews in short 4-year chunks. And remember, we're not talking about some generic warehouse here. This is a hyper-customized supercomputing site built specifically for Meta's hardware. If Meta decides to just walk away after a 4-year lease, those bondholders are left holding the bag on a highly specific, totally empty building for the next 2 decades.
All right, part 3, a $1 trillion systemic risk. Now, if this highly specific off-book magic trick had just stayed a one-off deal for one company, it might just be an interesting accounting footnote. But that is not what happened. This exact financial maneuver was rapidly adopted and scaled up, basically turning a clever accounting trick into a massive systemic vulnerability. Wall Street wasted no time marketing the sequel. Meet Project Sopapilla. Just like Benater, BlackRock, JP Morgan, and Morgan Stanley launched this identically structured $12 billion bond sale for another massive AI data center in Texas. Same structure, same 80-20 split, just a different project name. The template was proven, and the floodgates were wide open.
So the absolute crucial takeaway here is that this structure has completely metastasized across big tech. We're not just talking about Meta anymore. According to estimates by Morgan Stanley, the total off-balance sheet exposure across the tech industry has hit a staggering $1.8 trillion. Yeah, trillion with a T. That's $1.8 trillion of obligations and guarantees essentially floating in the financial ether, completely invisible to anyone just glancing at a standard corporate balance sheet. When you actually look at the numbers, the scale is genuinely breathtaking. This invisible pile of debt has grown roughly 8 times over since just 2022. The law firm Quinn Emanuel tracked $120 billion moving off balance sheets in under 2 years. Add to that, Moody's has identified $1 trillion pledged for future AI leases, with over $660 billion currently completely invisible on main balance sheets today. Basically, the hidden debt is quietly but very rapidly outgrowing the public-facing numbers.
Part 4, Echoes of Past Crises.
Here is where the problem deepens. It's not just the sheer amount of debt, it's who is holding it. When you have 5 giant corporate borrowers using the exact same financial structure, and it's all funded by the exact same tiny club of Wall Street lenders, the risk stops being diversifiable. It becomes a single point of failure. It's essentially the exact same bet written over and over again. And history actually gives us a really clear warning about this. The last 2 times a financing structure standardized this rapidly across an entire industry, we saw some pretty devastating results. From 1998 to 2000, it was telecom vendor financing, which gave us the dot-com crash. From 2004 to 2007, it was mortgage securitization, leading straight to the 2008 global financial crisis. Today, it's AI data center off-book leases. To put that into perspective, a veteran litigation lawyer at Quinn Emanuel, a professional who spent years of his life personally cleaning up the catastrophic fallout from 2008, was asked what it was like watching this exact AI financing trend unfold across the industry today. He described the situation with 2 incredibly chilling words: déjà vu.
Which brings us to our final section, Part 5, the four-legged AI parlay.
Because of this massive off-book exposure and just the insane velocity of the spending, the whole nature of this AI boom shifts. When you zoom out and look at everything that has to go perfectly right to keep this system afloat, it stops looking like a standard tech investment. It starts looking like an incredibly high-stakes wager. Honestly, to really grasp the risk, we can compare it to a sports parlay. For those unfamiliar, a parlay is a single bet that links together multiple distinct wagers. The payout is huge, but there's a brutal catch. Every single condition, every leg of the bet has to win. If you bet on 4 things to happen and 3 hit perfectly but just 1 fails, you lose the whole shebang.
The tech industry's massive off-book data center build-out is essentially a four-legged parlay. Here are the 4 massive legs stacked on top of each other. First, AI revenue must multiply. Second, cloud returns must urgently stop shrinking. Third, the Wall Street borrowing window must stay wide open. And fourth, the physical power grid must absorb the load. Let's break these down one by one.
Let's start with the first leg, the revenue gap. Right now, current AI revenue across the industry is sitting at roughly $110 billion, but the spending, that's tracking at over $700 billion. Because of that massive gap, AI revenue can't just experience, healthy, steady growth. To justify all this infrastructure debt, that revenue absolutely has to multiply.
Now for the second leg. The return on every new dollar these cloud giants are investing is dropping. Historically, it sat comfortably around 40%, but today, it has already slid toward 20%. And projections indicate that if spending keeps up at this pace, returns could easily fall to 10%. That downward trend absolutely must stop shrinking for the math to work out.
Leg 3 requires the capital markets to cooperate unconditionally. Morgan Stanley tallies the planned build-out at roughly $2.9 trillion through 2028. Now, the tech company's own massive cash flows can only cover about $1.4 trillion of that. That leaves a massive $1.5 trillion funding hole. The borrowing window on Wall Street literally has to remain completely wide open to plug that gap.
Finally, the fourth leg leaves the financial spreadsheets and enters the physical world. The already strained U.S. power grid must somehow absorb all this massive new infrastructure load without failing. And this is all happening at a time when the largest power market in America is already pinned at its absolute price cap. Look, you can have all the clever off-book debt you want, but if you can't physically plug the building in, it's totally useless.
So as we conclude this explainer, looking at a system built on brilliantly hidden off-book debt, backed by identical structures and the exact same few lenders, we have to ask ourselves a very serious question. With 4 precariously stacked conditions, revenue, returns, capital, and power, what happens to the global economy if even just one of those legs fails to hit? Thank you for exploring this with me today, and hey, always keep your eyes on the footnotes.